Do you know that despite the introduction of affordable housing projects by the government of Kenya sometime last year, most of us, the employed Kenyans, continue to procure and acquire loan facilities in order to either build or buy residential houses for our families to occupy. Now, this loan facility that we acquire, it does not come free of charge. You have to repay it plus interest over and above the amount that you borrowed. Let me now tell you a secret, that most of us, indeed yes, we have been repaying this amount religiously on a month-to-month basis. But what if I tell you, you have been overpaying that amount? Would you believe me? Okay. The question is, have you ever had a conversation with your HR manager or your accountant, letting them know that indeed you have a mortgage facility that you procured for the sake of building or buying a residential house for your family? Yeah, that's the question. Have you ever? If the answer is no, I tell you for sure, you have been overpaying that mortgage facility. And now that you know, I will expect you to do better. The laws of Kenya have a provision that any employee who procures a loan facility for purposes of building or buying a residential house for their family to occupy, the mortgage interest that comes as a result of that loan facility is deductible from the taxable pay up to a tune of 30,000 Kenya shillings per month, which translates to 360,000 annually. Did you know that? That you can easily reduce the pay as you earn that you pay to the government. You know, sometimes we do blame the government, saying that taxes are very high. The government keeps increasing the tax rates. But are we aware of the discounts of the tax reliefs that also the government has given to us to take advantage of? Let's talk about two employees, both earning 100,000 per month. But the difference between the two is that one has a mortgage facility and the other one has no mortgage facility. They are both exposed to the same statutory deductions. Talk of SHIF, talk of NSSF, same. Now, what does employee A, the one with no mortgage, pays per month in terms of pay as you earn? The taxable pay is 100,000. When you subject 100,000 to the graduating tax scale, the pay as you earn that results is 22,383 per month. 22,383. Now, let's compute for the person with a mortgage facility. What mortgage facility? They borrowed 3 million Kenya shillings from a financial institution, and they agreed that they will repay with an annual interest of 12%. So what is the mortgage interest that this person is supposed to pay per year? It is simply 12% of 3 million, which is 360,000. Now, 360,000 is per year. Let's convert it to per month, which is equal to 30,000. And therefore, when computing the pay as you earn for this individual, we don't subject the whole 100,000 to the graduating tax scale. Instead, we first deduct the 30,000, we are left with 70,000. When we subject the 70,000 to graduating tax scale, we get a pay as you earn payable of 12,383. Let me calculate again, of 13,383. So what is the difference between these two individuals who are being paid the same 100,000, but one has a mortgage facility and the other one has zero mortgage facility. The one with zero mortgage facility is paying 22,383, and the other one with mortgage facility is paying 13,383. The difference between the two, 9,000 per month. Convert that to per year, we are getting 108,000, a whopping 108,000. So let's assume that this mortgage facility you have acquired will run, or you will service it for 10 years. So for 10 years, how much will you have saved in terms of taxes? It is 108,000 per annum multiplied by 10 years, and you have 1,080,000, a whopping 1 million. That because of your ignorance, not following the law to the letter, you subject yourself to a loss of 1 million Kenya shillings. Some amount of money that is equal to take your child to a good university for undergraduate degree, and the same amount to pay for your child's master's degree if you want to pay for them. 1 million Kenya shillings. Okay, let bygone to be bygone. What you need to do so that you can start enjoying this mortgage interest discount that is offered by the government of Kenya. The next time you go to the office, even if it is tomorrow, carry with you the following documents. The loan agreement document. When you were signing for that loan facility, for that mortgage, there's a document that you signed with the lender. The document that shows how much you borrowed, you are supposed to repay within what period of time, and at what interest rates. That document must be somewhere, either in your laptop, have a physical copy somewhere. Make copies. Then go have a conversation with your HR or the accountant. Let them see it. Then number 2, also carry with you the loan statement. If you don't have it, you can visit the same lender, the same financial institution that processed for you that loan, and they will give you a loan statement. The loan statement basically shows how much you have been paying on a month-to-month basis, your repayments. Carry it with you, and of course you will need to demonstrate to the accountant, to the HR manager, that the loan that you borrowed, you used it to construct, to build a residential house that is occupied or is to be occupied by your family members. And number 4, you need to demonstrate that this loan amount, you borrowed it from either a registered, a licensed, or financial institution by KRA. And once you're able to demonstrate that, I promise you, from next month, your taxable pay, if you are paid, for instance, 100,000, will reduce from 100,000 to 70,000. And the pay as you earn that you are supposed to pay will reduce from 22,383 per month to 12,383, and therefore make you save a whopping 9,000 Kenya shillings. But before you go to the accountant, just make sure that these points are very clear to you, that the loan amount that you acquired is to build a residential house for your family to occupy, not for rental houses or a commercial building, for your family to occupy. Number 2, that you will only get a tax deduction based on the interest expense, not the principal amount. The 3 million that you paid, you will continue to pay it. But the only advantage that you have, as far as pay as you earn is concerned, the accountant, the payroll master, should be able to reduce the mortgage interest. Number 3, the amount you borrowed must have been acquired from a registered, licensed, approved financial institution. And there's a limit to how much you can benefit from that arrangement, a maximum of 30,000 per month. So don't go there demanding to the HR or the accountant to deduct a whole 50,000 if that is what you are paying on a monthly basis as interest expense for that mortgage facility. If that is clear, this is a challenge I'm giving to you. That first of all, you know very well whether you have a mortgage facility or you don't have. If you have, then prepare those documents, the mortgage documents, and furnish your accountant with those documents. Number 2, let them deduct the mortgage interest from your taxable pay before they compute the pay as you earn for you. Number 3, always review your payslip on a month-to-month basis just to ensure that our good accountant, our good HR remembers to do what? To deduct that mortgage interest. Because when you do that, you will ensure that you stop paying taxes blindly. You will use tax laws wisely, and by doing so, reduce your pay as you earn, as you endeavor to build your house with financial intelligence.